You know, the market's at an all-time high. Feels like investors have crossed a lot of things off the worry list in the last week or so. Naturally, trade deal of some sort with China. The new NAFTA is on the way. Federal budget deal even. And, of course, we got the impeachment vote, and the market has found really nothing in there to price in terms of policy implications or the election. What's the next thing to worry about from a policy perspective?
Yeah, well, look, I think on impeachment in particular, the market has been right to be pretty sanguine about it. I think that the market was expecting the House to impeach, is expecting the Senate to acquit. If that obviously doesn't happen, then that would be a market surprise. But one thing that impeachment could, or sort of two ways that impeachment could inform policy outcomes. One is on, you know, how does this inform President Trump's reaction function? Does this affect his willingness to sign that, that budget deal into law? Is he going to try to change the narrative around trade or immigration, things that he can pull the levers on without Congress? And then does it have electoral implications in the House and in the Senate? So you're right that I think that the market has been appropriately sanguine, but it could actually have policy implications. They just may not be apparent right now.
And those policy implications, I mean, when you talk about does it affect his willingness to sign this budget deal, you mean his unwilling? Would it make him less willing?
Yeah, would it make him less willing? Yeah. Because of course we saw it back in December of last year when he was trying to change the narrative, when he had some personnel changes. He did not sign that government funding bill into law. So could we actually see that again? Now it looks unlikely, but you just don't know.
We just don't know. Yeah, Jim. In terms of stuff the market normally is trying to feed off of, it's been pretty positive, as you know. Pretty broad expectation that we've seen a kind of a low in the economic growth trend, even though the numbers aren't necessarily confirming that. Where do you think all that stands getting into next year in terms of being able to play a little bit of a cyclical rebound?
Yeah, I think the next biggest thing, Mike, for the market is going to be earnings. And they're either going to turn up here, they're going to accelerate following sort of better information coming out of the economy across the globe here of late, or they're not. I think they're going to start to accelerate, and that could bring another run again, because I think there's the one negative all year has been decelerating earnings or flattish earnings trends. And if they do turn up here, let's say in the first quarter, they're going to turn up from a sub 2% 10-year Treasury, from a lot lower inflation than the last time they were rising, from much greater policy support from monetary and fiscal authorities, from still relatively lower valuations, and I think for a lot of portfolios that are underallocated risk assets in general. And I think if earnings turn up, it's kind of the idea that this recovery does have legs, and at a minimum, maybe we have to reduce our bearish bets and add a little more to cyclicality. And I think that could be another leg yet for this in 2020.
Libby, I want to go back to China trade and the so-called phase one deal. I mean, the Trump administration, part of the reason we got here with tariffs and everything else is because we have had several administrations over the years try and bring China to the table in terms of better trade practices and the like, and they failed in large part because China has agreed to make changes and then not followed through on those changes. What's to say that that doesn't happen again coming into next year and throw the entire thing back into the, maelstrom of craziness?
Right, and Morgan, I think that's a great point. And how we are viewing this phase one and characterizing with our clients is this really is a reprieve and escalation versus a grand bargain or a massive de-escalation, right? Because of course we will still have tariffs on $250 billion of goods at the 25% level. You'll still have 7.5% on $120 billion. So I think from the U.S.'s perspective, they still have leverage in order to enforce against sort of the China's promises. But in terms of what we've seen in the phase one deal, look, do we see maybe some progress on IP enforcement? Maybe some progress on forced technology transfer. Maybe, but this is really not that substantive of a deal, and as a result, you actually haven't seen that big rollback in tariffs I think the market was hoping for. A lot of the tariffs still remain.
Jim, one of the effects, or a couple of the effects of the trade frictions has been perhaps to suppress, bond yields. There was that kind of fear trade that has been slow to unwind, frankly, although it's maybe starting right now. And then also just reducing the volume of global trade. So do you think there's anything in this de-escalation phase that is going to allow those things to reverse in a bigger way?
Well, I think it is kind of happening, and partly because people see sort of a pause button. I agree, it's not over. I think we're going to continue to have trade wars for a generation here, and this is going to be kind of a common theme that is going to be going on for the next several years, I think. But I do think what's different in looking at 2020 from 2019, what made the trade war such a big deal in my view was the global economy was slowing throughout the whole episode. And recession fears were spiking, and people attributed a lot to the trade war. I don't think it had a lot to do with it. It was just a spurious correlation that they happened at the same time. If we still have antagonism on trade, which I think is very likely yet this year, the difference will be if the global recovery is picking up, I think that really diffuses the impact of the trade negotiations. You know, China's PMI just went back above 50. Our market PMI in this country has gone up for 3 months to over 52. You know, we're seeing German bund yields rise, which is a sign of activity picking up there as well. And if it's against a backdrop of accelerating or reviving global growth, then I think the trade war is not going to be nearly as impactful as it was in 2019.